Okay, so OBS is started. I'm going to share my screen for you guys. Let me do that. All right. And let's, I'll drag this over. So yeah, kind of like I was talking about, if you guys have any investing questions at all, just drop them in chat while we're going, and I'll kind of get to them or spin back to them towards the end. If not, I'm going to, after this data review, probably talk a little bit about something called tax loss harvesting, which is kind of a tax strategy for a lot of you that already are investors and have capital in the markets at a time like this. It is an extremely important strategy because, you know, it keeps the majority of the money you're actually making on returns in your pocket, and not something that's going towards taxes. So we'll talk about that. It's something I'm personally doing in my portfolio at the moment when we see these types of drastic drops in price action. But without further ado, let's go over some data from TJ here. So he tells us, hey, coaches have attached some more data to review. All of 2024, 28 major pairs. So he basically did every single pair just about, with no break even. Interesting, he said the data equity curve is quite volatile. Sure, there are some hyper aggressive trades in there. Interested in the next step, so use your feedback and retest, apply the feedback and continue, or test with 2024 with break even for comparison. So some good questions and breakdown here. Let me pop open the data. All right, so definitely agree with what he's saying there with the volatile equity curve, which that likely tells me very quickly. Let's actually zoom a little bit out here. So let me drag this to the next screen in case I see any questions come up. But what this kind of tells me fairly quickly is the win rate might be on the lower end, which we can kind of already see that. And when the win rate is on the lower end, you're going to have, you know, maybe some of you may have learned in, you know, an old data or math class, something called a line of best fit. And a line of best fit is essentially if you took an accumulation or average of all the points and drew a line amongst them, you would kind of get a different slope. You know, I'm bringing up a lot of math terms from stuff you guys probably have PTSD over, me too, but you know, the slope of that line kind of determines essentially the growth pattern, and it can be closely related to your win rate. So when I do see these charts that are very high swings up and very bearish swings down like this, kind of tells me there's a lower win rate overall and not necessarily that consistency that we're looking for. So we will dive a little bit more into these trades. I want to take a look at the data here. So 27.79% win rate in that. Okay, that's no break even, as he mentioned, which is not bad. A little bit on the lower end though. For profitability, you need about 26% or higher with our 3RR strategy. So 27.79 is just kind of over that line of profitability. But you can see overall he did end with some great profit, which is obviously an advantage to that. Now, just want to look a little bit. So 132 wins total, 343 losses, and he almost doubled the account here, which means he 106, 53% gained. Oh, I see. Wait a minute. Let me. Unless some information he typed in here was incorrect, but 200,000 starting balance, 106 gain. The math is not necessarily math in there, but that's fine. We'll just take a look at some of these trades here. Let's get verification. We'll put this on a new tab. Okay. So I will look at a few before drawing any conclusions. If some of you already know what I might say about this trade in chat, feel free to drop that. But there's something I'm noticing about this trade already. But like I said, I'd like to look at a little bit more before kind of drawing any conclusions amongst it. Okay. I don't know what oops is as well. It says a TP, but it says oops. So I would like to look at the take profit, which would be nice to see. Unless it was a, you know, an error with logging it. Changed up the chart colors a little bit here. All right. Hate these advertisements on the these every time I pull it up. All right. No break even, helping in that case there. Another SL. Another stop loss. Okay. So just with some of the ones I'm looking at now, there's definitely some pointers that I can give that I think would improve that win rate pretty significantly. But number one is going to be avoiding those ranges. It was one of the things I noticed right away when I'm looking at a chart like this and I see this dead ugly volume and very sideways price action. I want to avoid this almost at all costs. As many of you use break even, you obviously would have lucked out in this scenario. It tapped you in, got you at risk free, and then you don't have to worry about it, which is nice. But in this case, he does not use break even, and it is very, very difficult to find profitability using this very low volume price action. At the end of the day, you guys understand we're looking for that institutional involvement in the markets, and we're just not really seeing that here. So I would avoid this as much as possible. And there was another one, kind of similar situation here, where I've talked about this before. Although this is your most recent trading range to the downside, I would not ignore when I'm seeing price kind of make these newer ranges going upward and upward, because what we want to be focused on is the most recent range overall, not just, choosing a trend and trying to hop in on that despite how much price has developed previous to this range. Because for me personally, after a setup like this, I would be shifting to the bullish direction because it is the most recent break of structure that I'm looking at. And it's kind of more aligned with current price action. So that's just something myself that I noticed over a few trades already. These ones don't look bad to me, definitely a bit aggressive, but there was a couple in here that I liked. I like this trade as well. I think it looks great. The no break even here helped him out, got that TP on it. Super, super ugly when it comes to the price action, but a great trade nonetheless. This one as well, nothing really I see wrong here. You can see no break even helped him in this case as well. And then this one, my only stipulation would be, kind of a preference thing. I think I would have taken the same setup, but sometimes these smaller ranges up here, we have fair value gaps and sweeps on both of these. So attempting to justify which one you would prefer to take, I like to do that by, you guys see my highlighter tool I use all the time. I'll mark my high, my low, and then my high again to kind of show what range I'm focused on. But, just something I noticed there. And then last but not least, this one here that we pulled up, I definitely would focus on the most recent price action here because there's almost a few different setups that I'm noticing. So once again, it kind of goes similar to what we talked about on this Euro Chef trade, but instead of just assuming a bearish trend and wanting to take a short position, just because if I'm seeing these newly formed, we have a great sweep on some equal lows here with a very aggressive movement, break a structure to the upside, fair value gap around the entry. I would 100% be in this long position. Of course, it looks like a miss here, but the general idea is I would 100% be focused on longing this market, despite this, what I would consider a trade that's been held onto for too long. We're trying to focus on those ranges in that most recent price action. And this is a fairly common one that I noticed too. So if some of you have this similar issue, maybe think about it here and based on what I'm saying. But I always try to focus on my most recent trading ranges that follow my rules. And in a case like this, I see the sweep on equal lows. I see the break of structure ups. I see the fair value gap. So all of these rules meet a bullish trade for me. And I would not want to overextend or hold a sell position for too long. Because I personally find that these trades work out significantly less often than focusing on that most recent price action. Now, let's take a look at it a little bit more. That alone is going to be a big change regarding data, in my opinion. And I'm going to definitely circle back to his questions at the end, but let's see here. Yeah, some of these trades look good though. I'll open some more here, just check them out. Yeah, a lot of these trades look pretty good though, overall. The chart colors keep changing, but I think it's because everybody's adjusting their layouts in FX Replay. This one, I think would fall in that category before I've talked about too. Just be wary of your stop loss, guys. If you have a bunch of consolidation and relative equal lows at your stop loss, price will drive right through that. That's kind of that's the fundamentals of how price moves. I talk about that a lot in the liquidity section, but fundamentally, structure, volume even, but all of these concepts are just a root of liquidity. Volume would not exist if liquidity was not present. Structure is only a concept created by the idea of liquidity in external and internal ranges. So fundamentally speaking, every single concept that we talk about everything on a chart boils down to liquidity. And if you're going against that, idea of liquidity and saying, well, I'm going to put my stop loss at an area where a bunch of lows are resting, likely a bunch of orders, you will end up having not only a lower win rate, but probably a significantly lower win rate. It's one of the simplest implementations I think that could help your win rate, is just really focus on stop loss placement. Try to avoid equal lows, equal highs, and having your stop loss resting there, because at the end of the day, you're with the rest of the people who have stop losses at lows and highs of ranges. So I would really recommend just being wary of that. Not a bad trade here. The chart colors are crazy. They've probably changed 4 times already. A lot of these setups look pretty good to me, but kind of like I mentioned, this kind of falls in the category of that most recent range I talked about. I always try to focus on more recent ranges because of situations like this. It worked out in this scenario, so it's no problem there. But in a lot of cases, these are the types of trades that end up like Pound Chef, where you're in them for weeks at a time, getting killed by swaps. But a lot of these trades look pretty good to me. I think those are going to be my relatively, I think I know whose charts this is just by the colors. I could tell who's changed. For most of you guys like who send me pictures and DMs and stuff, I can kind of tell whose chart it most likely is just by the colors. But yeah, so this is kind of a similar situation I talked about, where I always want to focus a little bit more on the most recent range, because although this broke structure to the upside and we have a sweep and not really much fair value gap in here, there's a little one there. For me personally, I'm seeing like liquidity being swept here in this consolidation area, a break of structure to the downside. We have a fair value gap in the range. I would probably be shorting this market, just because, once again, it's this whole image that I drew is the most recent range that follows the rules of our trading, compared to, I really do not like to hold orders to this extent. Like, I don't like to have an order that sets up and then let that sit for too long when I'm seeing other newer positions, more recent price action form setup. So I really try to focus on that most recent range. And that is a huge improvement on not only my strike rate, but people I've talked to about it say it's a huge change they've made. This isn't bad. It kind of falls into that category. You can see this is technically our most recent trading range that follows our rules, so that's why I think holding this one is perfectly fine. But if we had newer ranges with liquidity sweeps and fair value gaps forming, this one I think would be a little overextended, but it's no problem there. Keep going a bit here. It's a great trade. And for those of you that rolled in a little later, I was telling them before, I could see like Sven did a poll on what to talk about here. And some of you that have been around for a while know I used to talk investing every single webinar. Literally, I used to talk about gold, silver, long-term investments, and all sorts of asset classes. So if you have any questions regarding investing, feel free to, think of them while we're kind of going through this data, put them into chat, and I'll swing back to them. And then at the end of it, anyways, I do plan on talking a little bit about tax loss harvesting for investment accounts. So that's something I'll touch upon once we kind of go through this data here. But let's take a look at some more of these trades. They look pretty decent overall. There's nothing that stands out too much. It's those minor details, though, that do compound in the longer term. Small fixes when you're working with a trading plan like this can make, great changes longer term. Now, I've briefly gone through some of them, and honestly, these trades look pretty solid to me. It's those few ones that I talked about that I would, advise on, those minor differences. But when it comes to his questions, I do want to briefly touch on these. So, using your feedback and retesting 2024, I've never been a huge fan of this, only because, as much as people say they might not remember it, if you've already tested 28 pairs in 2024, you're going to remember some price action, you're going to remember some trades, and it does kind of skew the data and the results. So I don't typically recommend this one. I think this would be the better option of the two when we're talking about these first two. But I do think this is something that should be applied as well. If you find that break even is something on the back of your mind and you're asking yourself, would it be better? If you don't have any concrete data showing that it's better or worse, I definitely would recommend this, because, if the majority of people here are using break even and it's helping their data, then the only reason I would recommend not using break even is if you have the data to prove it. And vice versa. So I've seen plenty of data that proves break even to work better for me, better for, even Andre, who's someone I've traded with for a long time, even students. So seeing concrete data that shows me that break even is an improvement on my edge is why I keep it around. So the only reason I would recommend not using break even like he does here is if you have concrete data that supports that. So without it, I definitely would put this on the top of that chain there just to make sure you're making a good decision data wise. But instead of doing that on 2024, I think my recommendation would be test other years. So maybe let's call it 2023, apply some of the feedback that I'm giving you, some of them regarding extending ranges for too long, focusing on more recent ranges. It's kind of a big one I've noticed already in the few trades we've looked at. But also just getting more comfortable with your edge in a different trading year. Trade the same 28 pairs if that's what you like to do, is trade all 28 on a certain year, but at the same time do a cause and effect testing is sometimes what it's called, but do a test on a specific variable, which is like break even, and just keep that log during it. So it's not like you have to do a whole separate set of testing break even versus not. Just every trade that you take and gets executed on FX Replay, keep a little note in an Excel sheet how it would have resulted with or without the break even, for example, and just kind of get a overall picture of your risk and reward. I kind of do that with my live trading journal at the moment. You guys know I added this little section in 2025. I didn't do it in 2024, but in 2025, my goal has just been kind of keep the log on the break even. I'll be honest, even if this were to be positive, let's say way significantly over my current RR, I still would not really make the change because you want to always focus on that longer term data. If there's 1,000 trades proving break even to work better, then you want to focus on the 1,000, not the most recent 40 or so that you've collected in the year. You know what I mean? So you definitely want to keep your backtesting data in mind. But this is what I mean regarding that cause and effect type testing or testing a certain variable, is just kind of maybe implementing this on your sheet of backtesting. You could toss it right in the end here, whatever you want to do, like a little notes, and test that on a different year. So that would be my main takeaway regarding your questions, but I do want to look through a little bit more of these trades here. Let me bring this over here in case I just want to make sure I don't miss any questions. Can you send me this Excel somewhere in chat? So if you go into data reviews and then you go into the rules, right up top here, there's the Simple Markets Backtesting Journal, and this will be an Excel version of it. And for those of you that don't like Excel, you can actually go into Google Drive and upload this, and it'll pan out basically how Sven uses it. I think Sven's a Google Drive user. I'm more of an Excel person, but whatever you prefer. But yeah, it is in that section there with the rules and kind of the requirements. So I know we should have a little note there that tells people that more because it is hard to find. But yeah, right in that rules for data review section, you'll find the Excel sheet and you can download it. Let's keep going a little bit here. I want to look at some more of these trades. Solid setup. So these ones are the ones, in my opinion, that are a bit overextended. Definitely, holding it for this long. In this case, it was not bad. You could see price did have some good volume here and picked up well. But this type of setup will definitely lead to some of those positions where you're just stuck in a trade for a really long time. And, it's not ideal. And at least in my opinion, it's not ideal to hold trades for that type of period of time. The swaps are going to kill you. The time you're sitting in it can tie up margin for some people who are on those smaller accounts, and it's a problem all around. It's a great trade. Yeah, honestly, a lot of these trades look pretty solid to me. A lot of the take profits. My Excel. Yes, I'll do it after the webinar. I'll be able to send you it. I have that call, so I might have to end the webinar slightly early, but yeah, I'll send you my Excel sheet. I think I have a clean version of it saved, I hope. And then yeah, I can send you that. But what I'm noticing, a lot of his trades look really good here. So one of the big things too I talk about is making sure take profits are realistic. It's a common issue where if people have these take profits that look extremely ugly in positions that I wouldn't be confident taking in a live market, it does lead to situations where people aren't even confident themselves to take it. So it's something where in backtesting, they may have gone and taken it because there's no real foul or no issues on the live account or on the backtested account. But when you're on a live account, some people will sit out of winners because of fear of them. And I think a lot of these winners look really good, really straightforward and clean. So no issues regarding that. Now this one here, you guys are going to know what I'm going to say already, but focus on the most recent range. That will really, really help with situations like this. Especially when you're working with a very small and tiny break of structure like this. I tend to avoid these very, very often. I don't take positions like this. We're number one trying to focus on trading ranges. That's kind of the fundamentals. You know, I talked about this idea of liquidity and how liquidity ties into structure and volume and different concepts. Trading ranges are fundamentally a visual representation of what liquidity is doing in the markets, and that's why I always talk about ranges specifically. And stuff like this to me is not really a trading range. This is just a simple like movement in price action of some bearish high volume, but there's no liquidity involved here and there's no real structure in price action, so I try to avoid these. But yeah, most recent range, so I would take probably, in my opinion, a loss here. I would have had this sweep on liquidity, this break of structure, this high volume, and I would have a short position right here, which would have inevitably maybe been a break even, maybe a loss. But that would have been my most recent range that followed my trading rules. So that's what I would have taken based on this image. Not bad, little counter trend position there. Oops. Great, now I'm going to get Coinbase ads all the time because I clicked on it. Yeah, a lot of these setups do look pretty good though. I feel like a lot of the ones that, let's see, is this a take profit? Yeah, a lot of his take profits, I think are really good, which this is an important factor here is he's not missing the clean, good looking winning trades. He is just taking, in my opinion, a little bit more of the uglier ones that I would tend to avoid. So, but I am seeing a lot of the winning trades he's taking here are similar to ones that I've taken on my live account and stuff. So it's really good that he's not missing those, which means he's, you know, leaving out a little bit more of the discretion. If that had a sweep of liquidity, when would you remove your PO when the range is forming? If that had a sweep of liquidity, let me check back if I can, hopefully I can find the image there. So are you referring to this position here, like this range? So when would you remove? Okay, so for me, if I see a new range that has my rules met, that's when I remove my pending order. So for me personally, I would have had this removed far earlier. Oops. Let me move this. So what I see right here is a sweep on liquidity, break a structure to the upside, fair value gap right around that entry level. I would probably have a long position from this low to this high. Counter trend, yes, but this would have been my signal to remove the trade. And if this didn't get the tap into the 75 and ran without me, it is what it is. But once I see a new range that forms with all of the rules met, that's my signal to remove a pending order. However, with that being said, I still don't think this is really a valid trade for me. I don't see a significant trading range. My break of structure here is very insignificant to overall price action. I can't tell if there's a sweep of liquidity here. There's just a few candles showing, and there's really like no fair value gap within the range. It's just a very small position overall. When you guys see me draw with my highlighter tools, I always like to see, you know, those strong, clear ranges. We have a good high here, a good break of structure of a low, a significant low here. So this is why I mentioned I would be shorting this position. It's a nice clean range. This one is just a few candlesticks. It's about 4 candles, and I don't typically consider that a range. So the most important thing though for me is the most recent trade that follows my plan. So the ones that follow the sweep, the break, the fair value gap, and the most recent range that does that is what I tend to focus on. Like these are great trades. We have a clear sweep here, perfect sweep, a break of structure to the downside. We have a fair value gap. It's the most recent trading range that is formed. It's a nice, clear, strong range. These are the ones that I would prefer to take. Also not bad. A bit odd regarding how he marked it because there's, it's tough to say where he would have seen this pending order. So it looks like he almost drew it after the overall break. This is why drawing your breaks and breaks and sweeps for all trades is important. We can see the sweep here is very clear, but if this broke structure of the high here, for example, I think it would have already been tapped in. It's kind of just a little bit off the way it was drawn here, but I still don't think it's a bad trade regardless. I see the rules are met. It's just the logistics of where his break of structure and sweep are can kind of make a difference there. I know it's FX replay too. FX replay is a little bit different. When I see trading view orders, I always prefer that you guys mark up every piece to the trading plan. It's just going to make it a lot easier for you guys to see and keep track of. But for you, Peter, again, this is kind of an example of what I talked about before. Yes, there's a sweep here. There's a break of structure, a little fair value gap around the entry. And it seems like his tendency is, once he sees this, set the order and walk away for a few months. I don't like to do that. I like to focus and watch price action, and I can kind of see within this range, there's a few areas that price sweeps liquidity, break structure. So I would be, kind of watching price develop and trying to keep up with it the best I can. Because I've personally found that keeping up with more recent price action is better results than setting and holding orders for too long. As you can see here, though, he did get the tap in, almost got the TP, but he doesn't use break even, so he did end up taking that stop loss there. We'll delete some of these. Yeah, overall, though, the trades look pretty good. I think the most important thing is his winners look great here. I always tend to look at that because, like I said, unrealistic winners leads to unrealistic expectations in a live market. Some people will have some disgustingly ugly winners that do not technically follow the plan, and it leads them to think their data is significantly stronger than it is. But then once they get to that live market, they don't have the confidence to go and take those ugly winners. They need those picture perfect A+ setups in their brain to go and execute. And not only is it a psychological issue, but it's an issue when it comes to actually mapping your back-tested data. So the winners look really good to me. No problems there. I think the biggest two takeaways that I've mentioned is one of them, especially following those most recent trading ranges, maybe trying to be less trend dependent. Now, I typically trade with trend too, but in a scenario like this where he assumes price is bullish way over here, so he wants to only take a buy setup, but he tends to ignore a lot of the more recent price action and ranges that are being formed. So that's probably my main takeaway that I think could definitely drag that win rate up a little bit from 27%. But the other one would definitely be just being wary of your stop loss placement as well. There's a few trades I've seen in here, none of these four, but a few trades I saw in here where he had a lot of equal lows or equal highs at his stop loss. And I think trying to, just be mindful of where your stop loss is placed can definitely be an advantage there and drag that win rate up slightly more as well. But just one more time for the takeaway on his questions, my recommendation is to, let's jump back here. We'll check that off. But my recommendation is to definitely trade a different year. So not 2024 again, because I feel like people remember price action. It's subconscious too. It does happen. Trade 28 pairs again, because I think you did a great job of doing that. A lot of people will send me like 100 trades on 4 pairs, but it'll be 4 years of data, and it doesn't really give you a great accurate picture of how your strategy would have performed that year, because as you know, we trade many pairs at once, not just 4 pairs over 4 years, for example. So this was a great representation of your data within that year, 2024. I think trade the other years, maybe do a little side test during that testing session and ask yourself, how did the trade play out with or without break even, and kind of get an idea if you would rather use it or not based on data, because I do think a concrete data decision should be made there. But overall, the data looks pretty good. I like the wins that you have. I think the wins are really realistic, really solid and clear wins. My biggest thing would be working on those minor issues regarding the losses, but it looks good overall. So let's talk a little bit about tax loss harvesting with investing, because I know a lot of people have messaged me about investing lately. Obviously, the markets are kind of shit in the bed right now, so it's a good time, if anything, to get started. But all I wanted to mention is number one, dollar cost averaging. And for those of you that don't know what that is, dollar cost averaging is essentially you pick a time period that you invest into the markets each month, each year if you want to. I prefer monthly. You can do weekly, bi-weekly, whatever you feel comfortable with. But I always recommend monthly. That's what I've personally done because I think it's at a good pace. You know, that's 12 times a year. You're not going to be overextending yourself. And let me just double check that I have no. Oh, yes, if I can mention the most important points again. The main ones I talked about were just following those most recent ranges. I think that was the biggest thing for him. But yeah, if you want to, you can always watch back the recording. This will be posted. I'm usually pretty quick with it, maybe 10 minutes after the webinar. But with dollar cost averaging, investing once a month gets you in at certain pricing, and it's called your cost basis from an asset class. So just as an example here, we're going to have these little lines on the chart. So let's say, you know, if I got into a really good price level at 333 because I invested on October 22nd or whatever, just essentially October, and then November came around, and within that month, I just invested here. And as you guys can see, I'm just kind of putting each line onto a candlestick. So there we go. So this is basically from October, November, December, January, February, and March. So if you're investing once a month at each month, you'll see these lines kind of stack up. And what you're doing is you're buying the same asset class at different price levels. And this is called your cost basis, or also known as dollar cost averaging. And what this means is that the cost of this asset class, so, you know, we have 5 months of investing here in this asset class at a fairly low point. The average of these numbers, so 333, 357, 367, 371, and 374, these are the different prices that you made your investment at. You can put whatever amount of money you want, but I recommend keeping it consistent. And what essentially happens is, I'm not going to do the math at the moment, but let's call it the average of these 5 numbers here is probably going to land, if I had to guess, somewhere around 362 maybe. So that would mean that right about here at 362 to the new current market high of 483, you could see we made about a 33% return on that initial capital that was invested at the low here. And this is the advantage to dollar cost averaging, because number one, you're ensuring that you are in the market and not trying to time the market. You know, famous saying, I tell a lot of people this, but time in the market beats timing the market. That's like a very famous investment saying. The longer you're in the market, the better results are expected, because there is periods of time that we will look at. For example, back in 2018, 2019, let's call it 2020, there's pricing where even if you invested at, let's just call it the all-time high of 2020 before the market crashed, you are still in this market at a price that most likely will never be reached again. This is a cost basis on your investment that will very likely not be reached again at any point. So taking that initiative and even investing in a quote unquote bad time at the all-time high of 2020, you are still in this asset class at a great price and can hold that and be profitable on that in the longer term. It's kind of the same thing we're looking at here. Not only did I invest at this all-time high here, because, you know, like I said, I invest just about monthly. So you can imagine at every candle, there's money that I've put into this market consistently. And even though price dropped down this low, my expectation is that even if I enter at a point like this, I can still expect a roughly 27% return on my capital because I continue investing each month. So it's kind of the rundown of dollar cost averaging and what I mean by that. Now, a little bit more of a confusing topic, but something that's good to know, is called tax loss harvesting. And this is essentially when price has a significant drop off like this. What I would do is any shares that I bought into this market up at the all-time high. So like I said, once again, I'm just dragging each of these lines to a candlestick because it represents once a month and it represents the general area that I bought in at that month. All of these shares that are above the current market point, let's just call it, you know, we'll throw a line right here and let's just call, or we'll throw it at the current low. All of these shares up here are valued at about $442 on average that I bought into this market at, but now the market's valued at 484. I don't know if I said 442 or 542, but regardless, you understand what I'm saying. The markets went down and those initial shares that I dollar cost averaged are negative in equity. I can go and sell off these positions now for an what's called a realized loss. Realized is when you sell your positions. And that realized loss, let's call it negative, you know, $5,000 on someone's portfolio. You can now write off that negative dollar value against the profits that you will make in the future. Because if I go and buy in here and price now raises up, and let's just say I made 10,000, I can now write off that $5,000 as a loss, even though I made 10,000. And what that means is I only get taxed on $5,000. I do not get taxed on $10,000 in capital gains. It's kind of, a little confusing there. I'll say it again slowly, but if you invested here, price drops down and you lose $5,000, you sell your shares of price, you reinvest it at this low, and then in the future, as we always expect, price will go up and eventually reach all-time highs again and keep going higher. In a normal market scenario, you would have gained, let's call it 10,000, whatever dollar value you want, apply it to your situation and portfolio. You would have gained, call it $10,000 in this scenario. If you sell that off, you're going to get a capital gains tax on $10,000. Let's call it 30%, and you're paying $3,000 to the IRS when all you did was just buy and hold at the low. The person who tax loss harvested that $5,000 decrease, price goes up by 10,000. So they're making the same amount in the same scenario, but they harvested that $5,000 loss. So now they're only being taxed on 5,000 instead of 10,000 because they took that 5,000 loss, made the 10,000 gain versus the person who only made the $10,000 gain. So instead of paying $3,000, which is 30% of the 10,000 gain to the IRS, you're now paying $1,500. So you cut in half what you owe on your taxable income because you were selling and actively managing that portfolio compared to the person who just buys and holds for a ridiculous amount of time. Now, mind you, I'm not saying to sell all your shares. I'm not saying to sell your whole portfolio. What I am saying is, be smart about it. I didn't sell, ridiculous amount of my portfolio here. I sold just enough where the value that I put in here could be written off as a realized loss in this case. And then I can go in 2025, I now have a certain amount of money that I can write off on my taxable income. In the case that by the end of the year or even in future years, we see price action go higher and higher, I now can write that off and save more money and keep more money in my pocket from my investment account because of the active management. So this is, a little bit of a complex topic, but it is important to know for those of you that are, very involved in investing with your accounts. And the big difference is from someone who is buying in, let's call it at a low here, and holding price forever and ever is up 139%. So you would be turning $10,000 into roughly $24,000 here if you held for this period of time, which is obviously great returns, but now that is $14,000 that if you sell off, you owe taxes on, compared to someone who is buying and consistently dollar cost averaging all the way up and getting their cost basis to follow price action as it moves and writing that off against their income. They're able to now save more of that $14,000 gain in their pocket because of the tax advantage of selling off at a realized loss. So all it is it's really, at the end of the day, saving you your tax dollars. But I always recommend holding long term, continue that compounding, keep investing monthly. It's even automated. I really recommend automating it through your broker. Some of them have advanced abilities where, let's say you wanted to put $5,000 a month away. You can even set your portfolio and tell it to every month put 10% in here, 15% in here, 20% in here, for example, and have it auto invest. I think that's one of the best ways to do it because you can set and forget it. But, if that's not in an option with a brokerage, if that's not something that you're comfortable with, then I do just recommend at the end of each month, maybe get a amount of cash aside, have a set amount and just invest it and continue to dollar cost average into your portfolio. So would you say that it is better to dollar cost average and every once in a while sell a small portion for the tax benefits and then keep buying? So technically yes to both questions there. Now, dollar cost averaging at all times is going to be king because you are going to get yourself in at much better pricing if price drops in these scenarios. But when it comes to selling a small portion for the tax benefit, that would only be applicable in these situations where we see these deep drawdown periods here. So these are the situations where if you're dollar cost averaging, because price drops so heavily and so quickly, you're going to sell off those shares that you have. So, like I mentioned, there's a lot of purchases that I made in these 4 months where price just kind of consolidated at the high. So all of those shares have decreased in value. So now I have the ability to sell. Otherwise, if price is continuing, for example, in 2024, we just trended up and up and up with very little drawbacks. I personally just bought 2024. I did not sit there and really sell any positions off, but it's because we had such a great up run in price action. There wasn't really any significant advantages to it. But when price drops this fast, this quickly, you can ensure that you're going to get yourself in at a lot better pricing if you sell a lot of this capital and reallocate it here. Now, got it. So basically good strategy for when there's a market crash. Correct. Yeah. So crash or recession, whatever you want to call it, any type of drawdown period when you are someone who's consistently investing, it's good to sell off because you're going to realize that loss on a taxable standpoint and then lower your overall taxable income. There is one thing I will mention about this. It's a little bit more of a meticulous rule, but there's something called the wash rule. And what that means is if I sell VOO, which is the currency we're looking at here on the chart, if I sell this currency at this price, I cannot buy back into the same exact currency, let's call it a week later. I have to, at least in America, I don't know about other countries and their rule, but at least here in the States, if I buy this currency, sell it off and try to buy back into it, it's called the wash rule, and they don't allow that as a taxable advantage. So when I do something like this, what I might do is sell off the shares that I want to, but instead of starting the investment right away when price is low like this, I might wait another 30 days and beat out that wash rule because I can't do it within 30 days. And then after the 30 days, I can go and invest that capital back into this market at a better price and essentially get the tax benefit from it. So that's just a minor rule there. I don't know if that applies outside the States. The States is all about, screw them with their tax dollars. That's what we do here. But for the States, at least, that is a minor rule that you might have to know if you're trying to apply this this strategy here. All right, what time is it? 45. I might have to get going, guys. I told you I have that meeting at 1 that I got to kind of get my notes ready for and stuff. But is there any other questions that you guys have for me before I wrap it up here? And as always, this will be posted in the live sessions channel too. All right. If there is no more questions, then that should be all. Yep, no problem, guys. All right, so I'll get ahead and post this, get it on YouTube, and then go and post this in the channel. If you guys have any questions after the webinar, obviously you can reach out, but I'll see you guys next week. Thank you.